Anybody else, any thoughts on this?
I'll add something just on the cost of insurance or the cost of protection that Kashif sir mentioned. And this is not as a microfinance practitioner, it is as an insurance practitioner. When we assess any risk that is brought to us by an MFI, by a lending body, bank or otherwise, the idea is to look at what the potential for loss in our terms for claims is, and to then we do a burning cost analysis, and you do the whole actuarial exercise, arrive at a price, give you the price, hopefully it's something that's palatable. What we cannot understand is, and I say we, what I cannot understand is, if there is a risk that has, let's say we're talking in terms of gross loan portfolio, that has a risk, a 2% risk of loss. And that is a 2% provision that is on your books in some way, shape or form. If an insurance company were to price it more than that, we would not be able to enter the market. Fair enough. However, if, for example, we give a 2% rate or a 1.8% in this hypothetical example, would it be appropriate for the lender to reduce their markup because they've now offset that risk from their balance sheet on that particular loan or that section of loan? So now their risk cost should be capped at the insurance premium price. And
touche,
if the risk is lower, then the premium will be lower because, again, we will never be able to sell more than what that risk is. So is there some space there where we say, how is this overall cost of the loan being built up? Probably the insurance can be hidden in there because it should be trailing what the actual risk and what the actual risk of loss is. I would add a point if I could, please.
Yeah, Zain.
In this discussion about insurance pricing or costing or technology, whatever the case may be, there tends to be a bias in such discussions that we talk about how things are today. So the technology cost is high today when we go and deploy this. The insurance premium cost per unit even is high today when we go and deploy it. I would say that it is perhaps better that if you get into the field, only then will you have a chance to reduce these costs with the data of putting this into practice. So either all of us will have a better understanding that no, we were actually underpricing this and the risk is much higher for the sector, or we will understand that no, the risk, we were overpricing it and it needs to come down. But it's only going to be through actually doing it that we can bring those down, because actuarial analysts are not going to do it. It has to come from the groundwork up, that we have raw data from the field that contradicts what those models say. And we can only really do that by actually engaging and getting these products rolling.
Okay, so how do we manage?
Just add regarding the customizing or the need for customizing products for microinsurance, also for microfinance customers, NBFCs, like was asked. Ultimately, the price or the policy that you get is a function of three items, which is the perils covered, the price, and then the premium, how it's going to be paid, what's going to happen with all of this, and what the payout is going to be. That is pretty much all there is into it. And if an insurance company is going to give way on one of those, stools of this proverbial, legs of this proverbial stool, then the other two will have to be shifted around to make way. But if, for example, if I were to put it this way, if they cannot afford the insurance, as we're saying, the insurance is very expensive, or at least it's a cash flow problem, as we know generally the segment of the country that we're talking here. Would it be viable, instead of giving a loan straight out the gate, to first give a loan for this insurance policy? So the premium of the insurance policy is what, 1%, 2%, let's say, for livestock. Of this 500,000 rupee animal, it comes to 10,000 rupees. So you give the 10,000 rupee loan, so that cost is offset, spread over a year or however long. And if they're the sort of person who's going to take this insurance and understand what this means, use that as a qualifying metric to give them a loan for the actual animal. There are solutions that can be made together that actually provide value to the customer as well. But it needs a lot of us sitting together and understanding these customers, because I do feel there's more to it than simply an affordability issue. Because it has to factor in somehow, like we started this conversation, that the risk has to be factored in somehow already. And are we missing a trick there by not recognizing it?
Yeah. Zain?
Well, it's going to be sort of a repetition of the same, really. But
Okay, then we're going to skip you.
the microfinance industry is particularly special from our perspective as insurers in how close to the customer you are relative to commercial banks and their customers. You know, we've heard examples here since yesterday about how microfinance operators, whether it is a bank or whether it is MFIs, are rooted in the communities that they're serving and they know them inside out. That level of knowledge or that level of information, I would say that as an insurer does not always come to us. So it doesn't always flow upstream. It stops at the level where for us it is this portfolio of the bank's borrowers and that's it. Where, like the question that came from the gentleman from RCDP, we would love to know more about that community, about how and why they feel this cost is excessive. If it is excessive in the context of the loss ratios that are being seen there or the kind of risks that are there, we'd love to know because, like I said, it doesn't make sense for us to have a product that cannot sell. So it is in our own interest, and definitely we are interested in making products that make sense for this sector. But the more we know, the better we can do that. So I would say collaboration, even though it's a word that's thrown around a lot, but practical collaboration and sharing of real hard data.